go to our guest, Erica James. Bear with me.
Hello, everyone. Hello. I'm here.
Nice to meet you, Erica. So, Erica is a self-employed financial consultant who helps people understand investing in self-directed IRAs. So I'm going to let you kind of just explain a little bit about what you do and then let us ask you some questions from there.
Okay, wonderful. Well, basically, I help people understand the options available to their retirement plans. Basically, self-directed IRAs allow people to invest in alternative assets such as real estate, precious metals, LLCs, promissory notes, etc. A self-directed IRA is regulated and governed by the same rules and foundations found within various sections of the Internal Revenue Code. It just allows you to diversify your portfolio.
And when you talk to people, are they surprised to find out that you can buy things other than stocks, bonds, and mutual funds inside of an IRA? Because I'm in the financial industry, and I didn't really understand that.
Absolutely. I would say somewhere between 80 to 85% of the population has no idea of the myriad of options available to them through self-direction.
Isn't that crazy? They could be more in control of their own financial destiny, and 85% of the population doesn't even know that exists, which is crazy.
Absolutely.
All right, so go ahead. I didn't mean to interrupt. Tell me a little bit more about, how you help clients.
Okay. Basically, so for example, someone decides that they want to diversify their portfolio and get out of the market and purchase like some real estate. So they would come to me. I would help them open up an account with a self-directed IRA plan administrator and basically help them purchase that piece of real estate in their IRA. So essentially the piece of real estate would be owned by the IRA, and all profits that they would make or any rental income would have to flow back into the IRA. In the same way, any expenses for the property would have to be paid utilizing the IRA. The benefit of this is that any, tenant, rental income that comes in would grow in the account or would come back tax deferred until you decided to start taking distributions. So that means if, you held this property for 10 years, for 20 years, for 30 years, up until the point that you're essentially forced to take distributions, you would just incur that cash. It would just grow and grow in the account, and you would not have to pay a dime in taxes on it. Now, that's federal taxes. Now, that's separate, obviously, from, the property taxes and all that other stuff. But in terms of federal taxes on that rental income, you would not pay any taxes on that.
And it's great to know that there's people like you out there that can help a consumer through this, because the 15% that do understand this, it's got to be a little bit scary. Like, that's your retirement, and you don't want to make purchases in your retirement that cause tax implications that you don't have someone like you that can kind of coach you through that.
Absolutely. And that's my job. I don't offer any advice. I don't endorse any end products. People come to me that already have expertise in certain areas, whether it be real estate or they want to invest in a certain company that they've heard about, or they want to, purchase some precious metals with their retirement funds. I provide the vehicle and they're driving. And it's really empowering to just understand that you can be in control of your retirement savings. You can decide how much of a return that you want on your investment. You can decide where you want to invest your funds. And this is completely – I'm sorry, go ahead.
No, I was going to say, Erica, that is so important and empowering for this reason. If you really understand how people get wealthy in the United States, the wealthy people don't invest in stocks, bonds, and mutual funds.
Exactly.
But as regular people out there, we feel like that's our only option. And to know that maybe we save money that we want to use for our retirement, and maybe we'd like to use it to be able to build wealth the way the wealthy people do. And to find out that that's an option is just empowering to know it exists.
And I'd actually encourage all of the listeners not to take my word for it, but go to Google, go to a search engine and type in Mitt Romney and self-directed IRAs, and you'll see exactly what I'm talking about. Well, just in terms of understanding the existing tax compliant structures that are available to anyone to be able to utilize and grow your retirement savings. So that money that you would have otherwise paid taxes on, you get to utilize that to make new investments. So if you want to buy real estate in your IRA, you can do that. If you want to, invest in precious metals in your IRA, if you want to invest in a privately held company, buy shares, you can do that in your IRA. And again, that rental, that tenant income, the dividends, the capital gains, if you're going to sell a piece of real estate, you're not going to pay taxes on that. So essentially, self-direction with relation to real estate has a built-in 1031 exchange in it, is that you're never going to pay taxes as long as that asset is held in the IRA.
And Erica, I always have a rule that I follow as much as possible. I never listen to what rich people say. I watch what rich people do. And that's the way that you learn how to become wealthy, because most rich people aren't going to tell you how they get rich unless they're making money from telling you how they do it. But when you see the things that Mitt Romney and these other people have done and have been doing all throughout years and years and years, you understand.
Oh, that's how they got the money to run their campaign.
Sure, that's how they get everything. And
exactly.
How many people do you know that have said, I lost everything in the stock market?
Exactly.
I mean, you hear that a lot. Short of the past 3 years in real estate, you never met anybody who said, I bought a bunch of real estate and lost all my money. I mean, real estate has always appreciated.
Sometimes they had to hold it for 30 years, and sometimes they got lucky in 5, but you didn't have many experiences where you lost money. And listen, I love to invest in something that's real. So to me...
Yeah, it's a secured note. It's not a share in a company or anything. It's a physical property or a portion of a physical property. It's secured. You actually own.
And I can even diversify inside of my IRA to have precious metals and real estate if I wanted to. If I wanted to hedge inside of my own IRA. So I have a question for you, Erica. Can this also be done to purchase other vehicles if it's inside of a Roth IRA?
Absolutely. I get this question a lot, and I always like to clarify there are 2 key things that are important with a Roth. You have to be 59 and a half, and it has to be vested for a minimum of 5 years. If you meet those 2 requirements, any earnings, capital gains, dividend income, it's going to be received, tax-free. Like you're not going to pay a dime because obviously you've already paid the taxes up front.
Okay, got it. But if I'm 38 and I have money in a Roth IRA, I can't use that to purchase real estate because I'd have to take the money out of the Roth IRA since I'm not 59?
No, you actually, if you have your Roth set up, you can move it over, to a self-directed IRA plan administrator and then invest it. The difference is that if you're not 59 and a half, even if it's in there for 5 years, if you're 39, you can't take it out without paying taxes.
Understood. So it can grow without me paying the taxes on it. And then as long as I don't touch it until I'm 59 and a half or older, then I won't have to pay the taxes when I take it out.
Exactly.
Okay.
You'll never pay taxes on that. And I really like to be clear on that because people usually think, oh, yeah, I'm just going to go get a Roth and I'm going to invest it and I'll get my money. No. Those are the 2 requirements. You have to be 59 and a half and it has to be in the account for a minimum of 5 years.
Okay. Got it. Makes sense.
As individuals, we're working for, a company, we have, 401k plans. You can contribute up to $17,500. But if you're a self-employed individual and you have a small business, depending on your income, you can contribute up to $51,000 a year in a self-directed IRA account. And converse, you can also, in turn, direct those funds to purchase alternative assets because, again, the account is a self-directed IRA account. So it's because of that, because, self-employment, obviously there's so many entrepreneurs out there, it's very attractive to them. And people, that are sort of like in my age group, if they don't already have retirement savings, they get the benefit of any contribution that they make, it's going to be tax deductible, it's going to reduce their taxable income, and they can invest it in alternative assets that they can control and, again, not pay taxes on until they take a distribution. That's if it's traditional. But then if it's a Roth, remember what we talked about, it's that 5-year requirement, 59 and a half, then they can take it out without paying a dime in taxes.
Man, Jim, you've had this so smart person that you've known all this time, and this is the first time I'm getting Erica.
Erica's busy. I booked her for as soon as we could.
I was going to say, I'm going to have to listen back to Real Estate Profits so I can hear I'm going to after I'm not doing the show, I'm going to be listening back with a pen and paper, writing it down.
And Erica, just you and I have had a couple different conversations before. Get into a little bit about doing it yourself or having an individual do it for you, because there are a couple different ways to actually do this, correct?
Absolutely. Well, basically, there's two basic components that I'll talk about, and then I'll branch off to explain it a little bit more. The first option is that you can have a self-directed IRA plan administrator or provider basically custody the asset for you. And what I mean by that is that's doing all the record keeping and administration, all the IRS reporting that's required. They can do that. Say, for instance, if you bought a piece of real estate and, you needed to, the toilet got stopped up in, the tenant upstairs, and you had to call rescue route, or, you essentially can manage the property through them. So you would not be able to, and let me just take a step back. The important thing with self-directed IRAs is you have to understand the rules around permissibility and prohibited transactions. So that's really important to talk about that. And what I mean by that is that a prohibited transaction is like basically you can have no self-dealing, like you cannot benefit in any way from owning an asset that's owned by your IRA. So, for example, you buy a piece of real estate, outside of your IRA. Then, after listening to this show, you think, oh, my God, let me get that piece of property in my IRA so I can, this tenant income that I have coming in, I won't have to pay taxes on that. That's illegal. You can't do that. That's considered self-dealing. You're self-benefiting there. The other component would be disqualified persons, and that's basically a line north and south of yourself. So, for example, your kid's going away to college, in Florida. You can't go and buy a piece of property there that your child would be able to then rent and pay you back. It has to be arm's length with undue influence. So that's the really, really, really key thing. I wanted to make sure that I took a step back and make sure that I explained that to the listeners.
Got it.
Yes.
Got it.
So it has to be arm's length, no undue influence. And basically it's really simple. Think north and south of yourself, including you.
Yeah.
Then it's a no-no. So those are basically the parameters there. Back to your point about the different ways that you can do it. You can utilize a self-directed IRA administrator to custody the asset for you. Again, do all the record keeping and the reporting to the IRS. And in that sense, for someone who's like a doctor or a lawyer, you're essentially going to become a property manager. You're going to become a real estate professional because you're going to need to know when the taxes are due, in terms of the roof, any sewage, any gutters need to be cleaned. You're going to have to do all that through the plan administrator, okay? So that's one option. And it's just important to note that if you're doing it that way, you're going to have to pay fees. It'll be a check. You have to write a check, essentially to whoever the contractor is that you hire to do this work because, again, you can't benefit in any way, which also means that there can be no sweat equity. So you can't go in and, snake the toilet yourself or clean the gutter. You have to hire someone to do it, but you'd have to hire them through the administrator. Okay? And if that's not clear, then I can go back and restate that because I know that's kind of a lot of stuff that I just said there, but I can go back and touch on that again. So that's one option is, again, to have the provider, the self-directed IRA plan administrator provider to basically custody the asset for you. The second option would be something called checkbook control, where essentially the asset that the administrator would hold for you would be an LLC. So you would go out, we would give you all the guidelines for establishing the LLC. In consortium with that, you would also open up a checking account. And then basically you would transfer your funds. Say you got $1 million in Morgan Stanley. You want a partial transfer out. You send $500 over to the self-directed IRA plan administrator. They then would transfer that $500,000 into a personal checking account or a business checking account, for that LLC that you establish. So in that sense, you would have checkbook control. But the provider would not do any of the record keeping, any of the administration for you. So that really, I really encourage people to exercise caution. That is an option available for you.
Can I add something? If they're not taking care of that, they're also not making sure that what you're doing is in compliance with the IRS, which sounds like a potential mistake.
Exactly. So that is an option for you. So all they're doing is just reporting on the value of the asset that is the LLC, which obviously they'd be able to monitor through the checking account. But they wouldn't be there to see if you're engaging in prohibited transactions, if you're doing business with disqualified individuals. They would do none of that. So you're really, really close to your money there, and I really would encourage people to exercise caution in regard to that. Okay, so those are the two options: through the self-directed IRA plan administrator, or on your own through checkbook control. Now, there's also an option where there's investment companies or investment funds that are for the purposes of real estate. Basically where the company would take money, from an individual, they would establish an agreement, and basically this company would locate, acquire, manage the property, and eventually sell it and then distribute the profits amongst the investors. So that would be like a special purpose vehicle, that's established for real estate investing. So if someone who wants to get in real estate, but they don't want the headache of, say, managing the property, or they don't want the headache of, say, wondering if, what they're doing is compliant with IRS rules and regulations, a special purpose vehicle, for real estate investing might be a good option to consider as well.
So, Erica, I just want to ask you this question. First of all, if I'm a person who has $500,000 in an IRA account and I would like to put it into a self-directed IRA and purchase real estate, but I don't want any of the headache, could I call you and say, Erica, can you help me, walk me through, hand me off to somebody that could be that special purpose vehicle that you spoke of?
Well, basically, the caveat there is that I cannot endorse any products or anyone or offer any advice. I mean, I would definitely recommend that I'm in the process of establishing, webinars and investment clubs where groups of investors can come together and discuss ideas of individuals be able to present, from an educational standpoint, exactly what it is that they're doing, the business model, and then, sort of informally in that way, basically talk about their companies and how they fit in with that model.
Jim, if she's teaching, I'm listening. She's got her first student, because I learned more in that 5 minutes of listening to her talk that financial people haven't told me in 15 years I'm in the business.
But there's one important thing we didn't talk about yet.
All right, go ahead.
If somebody's listening out there, Erica, and they want to get in touch with you to ask you questions, how can they do that?
Good question.
Well, the best way to do is just you can send me an email or you can give me a call. My email address is erica_JAMES30@yahoo.com, or they can reach me by phone at area code 312-399-4883.
So, Erica, we really appreciate.
She's going to be coming back on. We're going to do every 2 weeks or 3 weeks. We're going to bring Erica on. She's going to do a segment a little more specific to a certain investment or a certain transaction.
Cool.
Kind of gave you the synopsis tonight to give you, a little bit of.
She baited us, Jim. She let us know how smart she is, and now we're going to have to bring her back little by little to get her smartness.
Thank you so much for having me on. I appreciate it, and I'd come back anytime. Just let me know.
Awesome.
Thank
Erica,
you
have a good night. Thank you for your time and expertise.
Thank you. Bye-bye.
Awesome, Jim. That was an A+ quality guest by Jim Butts.
Yeah. Well, they've heard me say the term SPV, special purpose vehicle.
Yeah. I thought you were talking about the Special Victims Unit. I was waiting for you to tell me what Belzer and Ice-T were doing.
That's what we do at Meridians Global, the company that I run. We take people who want to use their money from a self-directed IRA.
She can't say it, but we can.
But I can. Yeah.
So you're the person that they would call.
They would talk to her first.
Yeah.
And then we would arrange the investment. What my company does is depending on, there's two strategies, whether you want a flip type of real estate transaction, where you're getting 20% on your money type thing. It happens, rather frequently. Every 6 months. We tend to have, a transaction every 6 months, 20% a year if you want to have your money out, quicker. Or we have a long-term investment where it's a little bit more complicated, where you put down a cash investment. You also secure a mortgage for the other part of the purchase price. We manage the property, maintain everything for you, and then give you back the full amount of the purchase price after 8.5 years. So in simple terms, you're buying something for $100,000. You put down $30,000. You take a mortgage out for $70,000. We collect the rent, pay the bills, manage the property, and after 8.5 years, we give you $100,000 back.
Okay.
So you're getting $100,000 for your $30,000 investment, which is 3.3 times your investment.
300%
ridiculous
in 8.5 years,
and it's secured. So it's kind of like a bond.
Dude, that's genius.
Yeah.
So, because I wasn't understanding it, I'm a little
in the
until
rental.
You gave me the math.
In the rental terms of it, now we take the appreciation, and we take the risk of depreciation.
Right.
But we take that. We have clients. We have arrangements with tenants. We handle all that stuff: screening, management, property, everything like that.
And you're just managing their money in the
there's
property.
a small management fee as it goes along, which
Yeah.
they still get their money back.
Yeah, they still get their, like you said, they invested $30,000, they bought a $100,000 piece of real estate, and in 8.5 years they got $100,000, but they only put 30 in.
Correct.
That's all you need to know. That's the only math.
Yeah,
and it's what risk is.
And it's secured. It's secured through real estate deed. It's not like a stock or something where you really don't technically own anything.
Sure.
You own physically a piece of property.
Interesting.
Or you can do the flip thing that we do. Like if you say, hey, listen, I don't have an 8-year or a 9-year plan. What I have is a 2-year plan. We can do that. We do the flip process. We do everything. We find the properties. We buy and sell. We've been realizing 25% return on that.
Which those returns are not typical and could change by transaction to transaction. But so far it's been good.
Yeah, good. And through hard work and diligence, that's kind of where it comes to. It's not magic. It's not a snake oil sales kind of thing. And if somebody wants information, it's info Global, Meridians Global.
Got to get that plural in there.
Yeah.
It was Meridians Global.
.com. And we can go through. We have presentations, anything that you really need to do, depending on what you want and how you are. Because I guarantee you there's nobody out there in the retirement sector that's giving you 300% return on investment in 8 years.
No, that is ridiculous.
You're looking at 5%, 6%. Slow and steady wins the race.
Not always in depressed real estate.
Yeah.
In depressed real estate, you can get bigger returns possibly.
Sure.
So.
And there are other avenues that are open to us through this special purpose.
So again, dude, 2 shows in a row. Last week you told people that it was possible to purchase real estate through a charity, through a nonprofit organization. And this week you helped us learn that we could buy real estate through an IRA.
Like I said, we have both different vehicles for the person, whether you're short-term or long-term. If you're like most Americans and you're looking at your IRA or you're
wondering how's it going to get there. I got 10 years left.
I got 10 years left. You're 40 years old and you're thinking, I'm either in the negative or lost money. I mean, I'm scared of the stock market. I don't trust the stock market. I don't trust
other people making decisions behind closed doors that determine whether or not I make money.
I don't trust anything.
I'm sure if you have
real estate, I trust. Yeah. I trust it, no matter what. Even through this horrible point, still, I trust real estate more than anything else.
I mean, here's what it is. In reality, the difference is you understand real estate. So you understand the possible pitfalls more than the average person.
Saying is, if you own a house, there is 0 to no chance that you can own a house that's worth $100,000 and wake up 3 days later and have it be worth $5,000. Once you start to lose principal on any investment,
it never comes back.
Not only doesn't it come back, it is so hard. You have to work so much harder to get back what you lost already. Somebody like us that takes the time and the diligence and research to find things, I would, as an outsider, trust more than the CEOs of the companies that are taking. Watch. Not Too Big to Fail. Watch Inside Job, the Jeffrey Lurie produced movie for
karmic hell they'll be in someday.
Yeah, someday.
All right. Well, thank you for being a part of this week's Real Estate Profits, Jim.